You did not cause it. You did not vote for it. You did not make a single financial decision that contributed to it. And yet, right now in February 2026, a global economic slowdown is building pressure around your income in ways that most people will not recognize until they are already inside the damage. That is the cruelest feature of a global slowdown. It does not arrive with a headline that says, your salary is about to be affected. It does not send a notice. It does not show up as a line item on your bank statement. It arrives quietly through 3 specific channels in ways that feel like bad luck or bad timing until you understand the mechanics behind them. Today, we are going to name those 3 channels precisely, because understanding the mechanism is the first step to protecting yourself from it. But before we get to the 3 ways, let's establish what we are actually talking about when we say global slowdown in 2026, because that phrase gets used so casually that it has almost lost meaning. A global slowdown is not a collapse. It is not 2008. It is not a sudden dramatic event that dominates every news cycle. A global slowdown is a sustained reduction in the rate of economic growth across multiple major economies simultaneously. Factories produce less, trade volumes contract, consumer spending pulls back, companies reduce investment, hiring slows. And because the world economy is deeply interconnected, a slowdown in one major region amplifies pressure everywhere else. In early 2026, the evidence of that slowdown is accumulating across multiple data points. Manufacturing activity in Europe has been contracting for months. China's post-pandemic recovery has significantly underperformed expectations, with domestic consumption weaker than projected and a property sector still working through structural excess. The United States, while more resilient than other major economies, is showing clear signs of a cooling labor market and decelerating consumer spending as the effect of sustained high interest rates works through the system. Global trade volumes, which are one of the most sensitive indicators of real economic activity, have been flat to declining. None of this is hidden. But the translation from global macro data to your individual paycheck is almost never explained. That translation is what we are doing right now. Channel 1, the job market cools before you feel it. When the global economy slows, the first place it shows up is not in mass layoffs. It shows up in hiring freezes. Companies that were planning to add 10 people quietly decide to add 3. Roles that were going to be posted never get posted. Internal promotions that were informally promised get postponed indefinitely. The job market does not collapse, it tightens. And the tightening happens gradually, invisibly, until one day you look around and realize that the leverage workers had 2 years ago is simply gone. This matters enormously for your income because the job market is the single most important variable in wage growth. When companies are competing for workers, they pay more, they offer more, they retain more aggressively. When the labor market loosens even modestly, that dynamic reverses. Employers become less responsive to retention concerns. The outside offer you were counting on as a negotiating tool becomes harder to generate. The raise that felt inevitable gets delayed by a quarter, then another quarter. Then it becomes a conversation that nobody is initiating. The workers most exposed to this channel are those in industries directly tied to global trade and investment flows. Manufacturing, logistics, export-driven technology, finance, and any sector where corporate capital expenditure is a primary driver of demand. When global growth slows, corporate investment is one of the first things to contract. And when corporate investment contracts, the people whose incomes depend on that investment feel it first. But this channel reaches further than export-heavy industries. Because when the companies at the top of the supply chain slow down, the pressure cascades through every supplier, every service provider, every local business that depends on the spending of people employed in those sectors. A slowdown in manufacturing in one city does not stay in manufacturing. It spreads to the restaurants, the retail, the services, the entire local economic ecosystem that depends on the wages of manufacturing workers. This is why a global slowdown that begins in trade and investment eventually reaches every income earner. Not at once, not with a dramatic announcement, but through a slow, branching contraction that follows the money until it reaches you. Channel 2. Inflation erodes the purchasing power of income that appears stable. Here is something that most income conversations get wrong. The question is not just how much you earn. The question is how much your earnings actually buy. And in an environment where the global slowdown is putting pressure on supply chains, energy markets, and currency valuations simultaneously, the real value of a paycheck that has not changed in nominal terms can decline significantly without a single dollar being removed from your direct deposit. This is the income erosion that nobody names properly. You still get the same salary, the number is the same, but the rent is higher. The groceries cost more, the utility bill has increased, the car insurance renewal came in 15% above last year. The cost of the things your income is supposed to cover has outpaced the income itself, and the gap has been widening quietly for 3 years. A global slowdown adds a specific new dimension to this problem. When major economies slow and central banks respond by adjusting monetary policy in conflicting directions, currency valuations shift. Imported goods become more expensive. Supply chains that had been partially stabilizing since the 2021 disruptions come under new pressure as demand patterns shift and logistics networks adjust to lower volumes. The result is that even in a period of moderating headline inflation, certain categories of everyday spending continue to run hot. Energy is particularly exposed. Global slowdowns frequently disrupt energy markets in counterintuitive ways. Demand may fall on a global level, but geopolitical responses to that demand reduction, combined with supply decisions by major producers, can keep energy prices volatile and elevated even as the broader economy contracts. And energy costs flow through into the price of almost everything else. Healthcare costs run on their own structural trajectory largely independent of the business cycle. In the United States, healthcare inflation has consistently outpaced both general inflation and wage growth for decades. A global slowdown does not pause that structural pressure. It adds to it, as fiscal stress at the government level creates pressure to shift costs to individuals and employers. The practical consequence is this. A person earning the same income in February 2026 as they earned in February 2024 has experienced a real income decline. The number is the same. The purchasing power is not. And because this decline is distributed across dozens of small price increases rather than concentrated in a single visible event, most people adapt to it without fully registering the cumulative damage. Channel 3. Opportunity contraction limits income growth for years. This is the channel that receives the least attention and does the most long-term damage. In a growing economy, opportunities multiply, new companies form. Existing companies expand into new markets. Industries that did not exist 5 years ago create new categories of employment and entrepreneurship. The trajectory of individual income is not just determined by the job you have today, it is shaped by the opportunities available to you over the next 5 to 10 years. And a sustained global slowdown compresses that opportunity landscape in ways that echo for a decade. When investment capital tightens globally, the flow of funding to new businesses slows. Startups that would have raised capital in a more favorable environment cannot. Expansions that would have created new roles do not happen. The innovation cycle that generates new industries and new income categories slows its pace. The result is not just fewer jobs. It is fewer of the right kind of jobs, fewer high-growth opportunities, fewer paths to income step changes that allow individuals to move meaningfully upward rather than just laterally. This channel affects different people in different ways depending on where they are in their careers. For early career workers, a slowdown that coincides with their entry into the labor market has disproportionate long-term consequences. Research on labor market entry consistently shows that workers who enter in a downturn earn less, not just in the first year, but for 5 to 10 years after, because they take lower quality initial positions that shape their subsequent trajectory. The cohort entering the job market in 2026 faces real structural headwinds that their counterparts entering in 2021 did not. For mid-career workers, opportunity contraction shows up as reduced mobility. The ability to move between companies, negotiate meaningfully on compensation, or transition into higher growth sectors depends on a market that is actively competing for talent. In a cooling environment, that competition softens. The leverage shifts, and workers who might have made a significant income-improving move in a different environment find themselves staying in positions that have plateaued, waiting for conditions that may take years to return. For entrepreneurs and self-employed people, a global slowdown hits directly through client budgets, consumer discretionary spending, and corporate procurement decisions. The businesses that survive slowdowns are the ones that recognize the shift early and adjusted their positioning accordingly. So now the obvious question, what do you actually do with this? The answer is not panic. The answer is not to abandon your career plans or make dramatic financial decisions based on fear. The answer is to update your mental model of the environment you're operating in and make calibrated adjustments before the pressure becomes unavoidable. On the income side, this is not the moment to be passive about your compensation. If your performance justifies a case for a raise or a promotion, make that case now while the window is still open. In a tightening labor market, the workers who advocate clearly for their value maintain better outcomes than those who wait for the system to reward them automatically. The system does not do that in a slowdown. It rewards clarity and initiative. Diversify how your income is generated if you can. A single income source in a global slowdown carries more risk than it did 2 years ago. Even modest diversification, a consulting engagement, a skill-based side project, an asset that generates passive income creates a buffer that a single paycheck cannot provide. This is not about becoming an entrepreneur overnight. It is about reducing concentration risk in your personal financial structure. On the cost side, revisit your real spending against your actual income, not the number on your payslip, the number that lands in your account after taxes and deductions, measured against what it actually buys today compared to 2 years ago. If you find a gap, it is better to identify it clearly and respond deliberately than to keep adapting incrementally without ever naming the problem. Build liquidity. In an uncertain environment, cash that is accessible is not idle. It is insurance. The emergency fund that felt like a conservative overcaution in a booming economy becomes a genuinely important buffer when the labor market softens and opportunities thin out. 3 to 6 months of expenses is not a maximum. In this environment, it is a reasonable minimum. And stay informed, not in the sense of compulsively tracking every economic indicator, but in the sense of understanding the specific dynamics in your industry, your employer's sector, and your regional economy. The global slowdown does not hit everywhere the same way at the same time. Knowing where you are in that sequence gives you time to respond that the unprepared do not have. We are in February 2026. The global slowdown is not a prediction. It is not a warning. It is already in motion, already working through the 3 channels we have described, already beginning to affect hiring markets, purchasing power, and opportunity landscapes in ways that will be visible to everyone within the next 12 months. The people who understand this now will make different decisions than the people who understand it later. Not necessarily easier decisions, not decisions that eliminate the pressure, but decisions made from clarity rather than from surprise. That difference is everything. The global economy does not ask whether you are ready when it shifts. It shifts. And the only question is whether you were paying attention before it arrived at your door. You are paying attention now.